Is Marvell Technology ticker symbol MRVL a screaming strong buy, riding an absolutely unstoppable AI wave? Or are we looking at an overextended stock flashing hidden warning signs right under the market's nose?
I mean, that is the multi-billion-dollar question right now. On the
Yeah.
surface, the chart looks like a rocket ship, but the moment you dig even a millimeter deeper into the order flow and the actual valuation models, the mechanics driving that ship get very, very complicated.
Yeah, welcome to the deep dive. Today, we're unpacking a massive stack of sources on Marvell. We've got their latest financial reports, a whole spectrum of analyst notes, technical charts, and, the raw order flow data.
Right, the real underlying numbers.
Exactly. We're going to figure out exactly what is happening under the hood of this recent surge. And by the way, tackling these kinds of massive market mysteries is exactly why we need you to leave your feedback in the comments.
Yeah, please do.
Tell us what ticker, trend, or topic to analyze next. Hit subscribe, like the video to support the channel, and let's just get right into it.
For sure. And we genuinely build our roadmap from those comments, so let us know what's on your radar.
Okay, let's set the stage with the raw numbers. The date is April 10th, 2026. Marvell closed at $128.49.
Huge jump.
Yeah, that is a 7.16% leap in a single trading session, hitting a brand new 52-week high of $129.84. I mean, those aren't just good numbers, those are market-moving, headline-grabbing numbers.
They're staggering.
Yeah.
But to understand this price action, we have to isolate the catalyst. The entire landscape shifted on March 31st, 2026.
Right, the Nvidia news.
Exactly. When Nvidia announced a $2 billion strategic investment in Marvell. And what's crucial here is that this wasn't just a generic cash injection into a partner. This was highly targeted specifically at Marvell's NVLink interconnect technologies.
Okay, let's stop right there because interconnect technologies sounds incredibly dense. For anyone who isn't, building data centers for a living, what exactly is an interconnect and why is Nvidia throwing $2 billion at it?
All right, so think about it this way. Right now, the whole world is obsessed with how fast a single AI chip can, think.
Yeah, the processing power.
Exactly.
Okay.
But when you are training a massive artificial intelligence model, you weren't using one chip. You're stacking tens of thousands of them together in a massive data center.
Okay.
So the bottleneck isn't the processing power of the individual chip anymore. The bottleneck is how fast those thousands of chips can actually talk to each other.
Ah, okay. So if they can't share the data instantly, all that processing power is just sitting there waiting. It's like having a Ferrari in bumper-to-bumper traffic.
Precisely. Traditional copper wires simply cannot carry that much data fast enough without melting or losing the signal. So Marvell builds the optical highways, the interconnects.
Oh, wow. Using light.
Yeah, they use light to transmit data between these processors at speeds that are almost incomprehensible. Marvell is effectively building the central nervous system that connects the individual AI brains.
So Nvidia knows their chips are useless without it.
Nvidia knows their own chips are useless in massive clusters without Marvell's nervous system.
Yeah. That makes total sense, and it perfectly explains the market reaction. From a psychological standpoint, this Nvidia investment acts like a kingmaker's blessing in the tech world.
Oh, totally.
When Nvidia, the undisputed heavyweight champion of AI right now, says, "We need this company's tech so badly we're buying in," the entire market just blindly follows the scent.
And we see that kingmaker effect incredibly clearly in the order flow. Following the March 31st announcement, the buying pressure from retail investors and, institutional momentum chasers has been astronomical.
Oh, astronomical, yeah.
But looking at the internal data, there's a fascinating divergence taking place. While retail is swarming in, the insider activity is currently classified as balanced.
Balanced meaning what? That the executives aren't buying the hype.
It means that while the retail crowd is rushing in to buy at these brand new 52-week highs, company insiders, so the executives, the board members, the people who quite literally know the company's internal roadmap better than anyone, are actually taking profits.
Wow.
They are selling shares into this massive rally.
Wait, so retail is buying the top and the insiders are just handing them the bags?
I mean, I wouldn't call it a panic dump. Most of this selling is done through pre-scheduled 10b5-1 plans to avoid insider trading accusations.
Right. Standard procedure.
Yeah, taking profits after a massive run is normal corporate behavior. But it does highlight a severe divergence in psychology. The outside world is blinded by the Nvidia halo and sees limitless upside.
Sure.
But the insiders look at a stock that just hit nearly $130 and decide, well, it's a very good time to lock in some guaranteed wealth.
That divergence is exactly why we can't just trust the hype. Let's look past the Nvidia headline and look at the actual business. Marvell's 52-week low was $48.09. It has run from $48 to nearly $130.
This is wild.
That's a 37.72% gain in just the last month alone and a 51.20% increase year to date. Do the underlying financials actually support that kind of explosive growth?
Let's break down the income statement from their Q4 fiscal year 2026. The top-line revenue hit $2.22 billion.
Okay.
That's a 22.1% year-over-year increase. Their net income is sitting at $396.1 million for the quarter.
Which brings their trailing 12-month earnings per share to $3.07, right?
Exactly.
Those are solid growth metrics, but the number in this report that really jumps out to me is the gross margin. They're sitting at a 51.02% gross margin.
It's massive.
In the hardware space, where companies are usually fighting tooth and nail over pennies, a 51% margin is wild. To me, that screams pricing power.
Absolutely.
They aren't in a race to the bottom selling commodity parts. They're selling highly specialized premium technology that commands a massive premium price.
And that pricing power is the bedrock of their financial health. You see the result clearly on their balance sheet. Right. Because they keep over half of every dollar they make before operating expenses, Marvell generated a massive $1.75 billion in cash from operations.
Wait, $1.75 billion in cash?
Yeah, not accounting profits on a ledger, but actual cash entering the bank accounts.
Which gives them huge flexibility. I mean, they can reinvest in R&D, pay down debt, or just weather an economic storm without having to go beg the banks for a loan.
Speaking of loans, their debt profile is incredibly healthy. Their debt-to-equity ratio is currently 33.48%.
Wow, that's really low.
Right. We're living in a macroeconomic environment where high interest rates have made borrowing incredibly expensive, crippling a lot of high-growth tech companies.
Yeah.
So having low leverage right now is a distinct competitive advantage.
Yeah, kidding.
You combine that low debt with a return on equity and ROE of 19.25%.
Let's define that ROE for a second, just so we're all on the same page. That essentially means for every dollar of shareholder equity invested in the company, Marvell's management is efficiently generating over 19 cents in profit.
Exactly. It measures how effectively management is using the money given to them. Nearly 20% is a fantastic rate of return. So if we look purely at the fundamentals, Marvell is not an empty hype train. They're a highly profitable, highly efficient, cash-generating machine.
Okay, so the fundamentals are rock solid. They're making money, they have low debt, and they're building critical infrastructure. But, strong financials are only half the battle when it comes to the stock market. Knowing whether to buy today, sell tomorrow, or hold for a year relies heavily on technical momentum and market sentiment.
Right.
So how are the charts actually looking?
From a purely technical standpoint, the signals are screaming bullish.
Looking at the charts in our sources, the key event was the breakout past the $120 resistance level. For months, $120 acted like an invisible ceiling.
It really did.
Every time the stock got close, sellers would just step in and push it back down. But once that Nvidia news hit, they punched through $120 with massive volume. It was like a coiled spring finally snapping.
Yeah, the volume was key there.
Now, the stock is trading well above both its 50-day and 200-day moving averages.
And for context, when a stock's short-term price average pulls significantly higher than its long-term average, technical analysts view that as confirmation of a very strong, established uptrend. The momentum is undeniably positive right now.
And the big Wall Street firms are feeding right into that momentum, aren't they?
They are. The institutional consensus is heavily leaning toward buy or strong buy. Following this recent run, Barclays upgraded Marvell to an overweight rating, and they raised their price target all the way up to $150.
Okay.
Citigroup also followed suit, issuing their own overweight rating.
When a bank like Barclays says overweight, what is that actually signaling to the market? Like, what does that mean in plain English?
Right, so it's an instruction to institutional portfolio managers. If a manager's benchmark index consists of, say, 2% Marvell stock, an overweight rating means the analyst believes the manager should hold 3% or 4% in their portfolio.
Ah, I get it.
They're basically saying this stock is going to outperform the broader market, so you need to hold more of it than average to capture those gains.
Okay, but wait, hang on. I'm looking further down our stack of analyst notes, and there's a glaring contradiction here.
Oh yeah, the Zacks rating.
Yeah. Barclays is pointing straight to $150 and telling funds to load up. But Zacks Investment Research currently has Marvell ranked as a number 3, which is a quantitative hold. How do we square a $150 price target with a system telling investors to sit on their hands?
That specific tension is the most fascinating part of our sources today. It leads us directly into the biggest debate surrounding Marvell. Is this stock currently undervalued compared to its peers, or are we looking at a textbook value trap?
Let's lay out the undervalued argument first, because there's one specific metric the bulls love to point out. Marvell's forward price to earnings ratio, the forward PE, is 27.48.
Right.
If you compare that to the broader semiconductor industry average, which is sitting at 29.01, Marvell is technically trading at a discount. So relative to the rest of the sector, you are paying less for a dollar of Marvell's future earnings than you are for the competition.
It looks cheaper than the neighborhood average. If you're shopping for a house and every home on the block is selling for $500,000, but Marvell House is listed at $450,000, it feels like a bargain.
Sure.
That is relative valuation. But this is where retail investors get into serious trouble, because relative valuation ignores the structural integrity of the house itself.
Oh, okay. So what does the absolute valuation tell us? If we pull the inspection report, what are we actually looking at?
When quantitative analysts run absolute valuation models, specifically discounted cash flow or DCF models, the picture completely changes. Well, a DCF model takes all the projected future cash Marvell will ever make, adjusts for inflation and risk, and discounts it back to what that cash is worth in today's dollars. According to these fair value estimates, the stock's true intrinsic value is actually around $90.07.
That's $90.07, but the stock closed at $128.49.
Exactly, which means at nearly $130, the stock has wildly overshot its fundamental intrinsic value. It's trading at a massive premium, driven almost entirely by the momentum of the Nvidia headline.
That is almost $40 of pure momentum premium baked into the price.
And that is the definition of a value trap. A retail trader sees that lower relative PE of 27, they see the $150 Barclays target, and they think, I'm getting a deal.
Right.
They buy a peak momentum, completely ignoring the complex cash flow models that suggest they're overpaying by nearly 30%. If that momentum breaks, if the market decides the Nvidia news is fully priced in, the stock has a long, painful way to fall just to get back to its actual fair value of $90.
Man, so to figure out if that $150 target is a pipe dream, or if that $90 intrinsic value is just overly pessimistic, we have to look at what the business is actually doing moving forward. We need to pit the ultimate best-case scenario against the worst-case scenario. What is the fundamental bull case for Marvell?
The bull case hinges entirely on their dominance in custom silicon for hyperscalers.
Okay, hyperscalers.
Right. We know they build the interconnects, but they're also winning massive contracts to design and build bespoke chips for the biggest cloud computing providers on the planet, companies like Amazon, Google, and Meta.
The real heavyweights.
Exactly. And based on these contracts, Marvell's management is projecting a staggering $15 billion in revenue for fiscal year 2028.
$15 billion.
That represents roughly 40% growth from their current trajectory. If they successfully hit $15 billion, the fundamental valuation catches up to the hype, and that $150 price target becomes entirely realistic.
I want to pause on that term, custom silicon for hyperscalers, because that introduces a massive element of risk. A hyperscaler is a giant tech company running massive data centers. Why do they need custom silicon? Why can't they just buy standard chips off the shelf from Nvidia or Intel?
Because as AI models become incredibly complex, standard one-size-fits-all chips are no longer efficient enough. If a company like Google is training a proprietary AI model with a very specific architecture, they want a chip that is hardwired specifically for that algorithm.
Right, makes sense.
It saves them billions in power consumption. Marvell provides that engineering service. They design the exact chip the hyperscaler needs and then manufacture it.
Okay, that explains why the margins are so high at 51%. Bespoke tailoring always costs more than off the rack, but that leads directly into the bear case, right? If you're a tailor and you rely on just 3 or 4 massive tech giants for the vast majority of your custom revenue, you have a terrifying concentration risk.
Yes, that is Marvell's Achilles heel. Their revenue stream is highly concentrated.
If one of those hyperscalers has a bad quarter, or more likely, if one of them decides to pivot their entire AI strategy and abandon a specific architecture, the custom chips Marvell spent years designing for them instantly become obsolete.
Exactly. Custom silicon demand can shift overnight. The hyperscalers are in an arms race, constantly evolving their internal designs. If a major client cancels an order or delays a data center rollout because their strategy changed, Marvell's revenue projections could take an immediate catastrophic hit.
And because the stock is currently trading at almost $130, supported only by momentum and a $90 intrinsic value floor.
The downside volatility would be brutal. The market would instantly reprice the stock down to that $90 fair value, ruthlessly punishing the late buyers who got in at the 52-week high, assuming the $150 target was guaranteed.
Right. So, summarizing this entire complex landscape for you, the listener, we're really looking at two totally distinct time horizons. In the short term, the market sentiment is clear as day. The technical charts are broken out, the moving averages are aligned, and the bullish momentum is expected to continue as the market fully digests the implications of the Nvidia partnership. The hype wave is cresting, and trend traders are riding it.
But in the medium to long term, the narrative is going to ruthlessly shift from hype to execution. Their stock price is currently writing checks that their future operations have to cash.
Well said.
Their long-term success relies entirely on avoiding those concentration risks, delivering on their custom silicon contracts without delays, and hitting that massive $15 billion revenue target by 2028. If they miss, the fundamental gravity of that $90 intrinsic value will pull the stock down.
Now, obviously, we have unpacked the technical breakouts, the deeply complex discounted cash flow models, and the fierce debates between institutional analysts today. But we have to clearly state that this deep dive is strictly for educational purposes. We're synthesizing the data from the sources to help you understand the mechanics. This is not financial advice.
Right. The goal here is to help you see past the headlines. Knowledge is your best asset, but you always have to apply it to your own specific risk tolerance and portfolio strategy.
Absolutely. So as we wrap up today's deep dive, we want to leave you with one final thought to mull over. Something that builds on everything we discussed about these custom silicon contracts and those massive hyperscalers.
Yeah, think about the ultimate endgame here. Marvell's massive 40% growth projection relies heavily on a handful of mega-cap tech giants paying them top dollar to design custom chips and optical interconnects. But these tech giants have virtually unlimited capital. What happens when Google, Amazon, or Meta eventually decide they have the resources, the engineering talent, and the cash to simply build these interconnects and custom chips entirely in-house?
Exactly.
Is Marvell truly an irreplaceable partner forever, or are they just a temporary, highly profitable stepping stone in the larger AI arms race?